Hi, this is Brett Olson. I want to welcome everybody to our kind of a update. This is kind of a special update that I usually do this on a quarterly basis. Decided to do something kind of in between with everything that's going on. I know there's a lot of concerns about portfolios and investments and just the economy in general. So I thought I'd try to put that in a little perspective. This should be a fairly short and efficient meeting. The goal is it's going to be very long, but just give a chance to just discuss a little bit about what's going on in the current world geopolitically and also from the standpoint of what's going on with our economy. So I will spend some time going into a little detail, not a ton, but hopefully put it in some perspective. First of all, just to let you know that if you do have any questions, we do have a chat room. So if you're interested in asking any questions, feel free to put a question in the chat room. So you should have an icon on your Zoom meeting that is for that. Also, if you're having any technical problems, feel free to give Andy a call. Andy is our person in charge of that. You can reach Andy at 262-649-9925. So if for some reason you're not picking up sound or something like that, feel free to give Andy a call and we'll work to correct that. These are pretty efficient. Sometimes we do have a situation where there will be a malfunction. So feel free to tap us on the shoulder and we'll do what we can to correct that. So let's get started. First of all, I wanted to let you know that as we go forward in the meeting, it is being recorded. We do have to record these anytime we're doing a public presentation. We have to have this available to be reviewed. So I did want to let you know that. So what you'll see now is I'll start to go through the presentation. First of all, what I want to do is cover a little bit about what causes market corrections. We're definitely in a point where we have seen a fairly good size adjustment in the markets. I know on a year-to-date basis, we are seeing that, for example, the S&P is down right around 9%. The Dow is down around 7.5%. The NASDAQ is down almost 15%. So those are some numbers that, although not in a bear market category yet, are getting relatively noticeable. Now, the good news is for 1 year, the numbers are still very positive. If you look back 12 months, realistically, we're seeing a lot of the markets have kind of digressed back to what we saw at the end of the third quarter of 2021. Our goal is to not really feel those downturns as much with a well-allocated portfolio, but it is something that all portfolios, if we're invested in equities, are going to experience. So why is that? If we take a look at what causes major market corrections, really what I look at and have found over the years, there's three things that we look at. One is cyclical. This is the business cycle. And this is what I spend a lot of time talking about if you read our every 2 to 3 weeks, you put a update on the website, kind of what's going on in the business cycle. These are the facts, the figures, what's going on as far as leading, lagging, and coincident indicators that we watch. This will give us an idea of where we're at in the business cycle. I'll go into that in a little more depth in just a second. Second is structural. This is kind of where you have a deterioration in the fundamentals of a concept, an idea, an asset class. It's not as much driven on across an economy or across a geo world that we're looking at. It is much more structural in an event that happened that is really a structural thing, like 2008, 2009, with the structural decline of some of the mortgage-backed securities. We had the structural event in the early 2000s were going to happen with a lot of the technology. These are what are called structural downturns. Or market correction. The third is event-driven, and that is, I highlighted that in red because that's really where we're at right now. This is an event-driven downturn that's accelerated. Now, all of it is not event-driven. Some of it is cyclical. We are looking at a cyclical downturn also because of some of the numbers. So it really is a combination of both cyclical, but the event-driven has really accelerated some of the things that have happened in the markets in the last few days. We look at the business cycle, and again, I spend a lot of time on the business cycle with clients, highlighting that. So when we're looking at overall, let me adjust the camera here. When we're looking at overall business cycle evaluations, this is common. And basically, again, what you'll find is the economy accelerates, the Fed raises interest rates. They want to slow down the economy because there's too much money out there that's flowing around. And we saw that with some of the Fed's easing because of the pandemic. And that is one of the things that we are dealing with right now. So what happens is you start seeing inventories increase, there's too much product on shelf, companies slow down, and then we see things, somewhat of a downturn. We have experienced that to a degree. Now, coming out of the pandemic, though, we did have a lot of demand. I mean, inventories were way down, and inventories still are down, but our production levels are starting to offset those, which we'll cover in just a second. So this is the cycle, and it is something that we do need to talk about. Now, what I do is I just put a copy in here of the every 2 to 3 week business cycle update that we put out. This is the fundamentals to how we manage money. We take into account both the event-driven and the structural, but also this is kind of the backbone of how you look at what your allocation should or be adjusted to at certain times, not over adjusting, not market timing, just looking at where we're at in the business cycle. So if you haven't seen this is always posted to our website. And I do suggest that you do take a look at that, because it will give us a little bit of thought of where we're at in looking at where we think the economy is at the current time. Now, as I always mention with this, the problem is it's not a clock that ticks. The clock sometimes will go forward. The clock will sometimes tick backwards for a while. We do get stuck or accelerate through certain parts of the cycle in a different way. So I do want you to be aware that it's not something that, although we try to make it as factual and from a educational standpoint, from an academic standpoint, as logical as possible, it's not sometimes as logical as you'd like, because there's indicators that sometimes are a bit false, and you have to adjust to the numbers because they do change on occasion. So it is something that when we're looking at, but it is a backbone of how we manage money. So let's take a look at some of the indicators and what's going on right now. I'm not going to spend a lot of time on each of these. I'm going to cover a couple of them in more detail because I think they're very important right now. But when you look at this overall, you can see, again, this is what we talk about in our business cycle. When you're looking through this, you'll see in our every 2 to 3 week little update that I do, I will go into details on each of these subjects. So when you're looking at it, for example, when you see I have here income and sales are slowing down, doesn't mean they're terrible numbers, but what we do is we have seen a slight pausing in those. And what I do with this, when you see the newsletter we put out or the little update, what you'll find is I try to classify those into yellow, red, and green. So basically what that's saying is green means that they're in a positive trend. Yellow is they're kind of positive and negative. There's some things we're looking at in both ways. And red is there's a little bit more of a concern with those numbers. And what I have been seeing lately, I have been seeing that there's been more yellow and red than there has been green. The last update I did, and again, it depends on which numbers you pick, but I try to pick ones that I think are going to be the most relevant to affecting our portfolios, is that we didn't have any green this last time. It doesn't mean it's a disaster. It just means that we are seeing some things that are beginning to worry us. And again, if we go through this in detail, you will find that I have a breakdown on each one of these that talks a little bit about this. But what I do want to do is focus on a couple of them now. One is the concept of inflation. When you look at what's going on in the inflation side, this is one that really does concern us quite dramatically when you look at inflation. Consumer prices keep rising, producer prices and commodities. You can see 7.5% year over year. Producer price of commodities up almost over 19%. Some of the finished goods up 12%. So what that means is we are seeing that margins are being squeezed. So when you look at these increases in the various inflation indicators that we have, it is something that we look at that does affect the consumer. And remember, the consumer is about 70% of our economy. So when we look at what's happening here, it is going to affect the average person that's out buying things, whether it be food, whether it be energy cost. All of those things are going to, especially energy cost, end up working their way into a lot of the prices that we're paying either at the pump or paying for products. I mean, I've seen an example. You look at, for example, a person that's filling up a semi, the cost difference for that driver, for that company, for that provider of that service is going up dramatically. Those prices will be passed along. They're not going to be eaten by everybody and not make any money at doing it. Otherwise, they're not going to drive their trucks. So it is one, when you're looking at this, this is a major concern that we have when we talk about inflation. So that is an area. Now, the Fed is addressing that. One of the things that you'll see, remember I said part of the business cycle is adjusting interest rates accordingly. What you'll find is you will see that you'll overall see that the Fed will take action. Now, the question we're all weighing is, has the Fed waited too long to maybe make this worse than it had to be with addressing inflation by raising interest rates? Has the Fed waited too long, leaving money too really easy to get by the monetary easing, putting so much money in the system, making money so cheap? Did that cause us to see inflation happen? Originally, we're talking about coming out of the pandemic being transitory. The theory is now that it's really not transitory. The question is, once we get the supply chains corrected, once we will get inventories back, once we will get people back in the workforce, the problem I have with that is only about our participation rate is still in the 60s as far as people participating in the workforce. So it is putting pressure on wages. And we are seeing that it is putting pressure on, the pricing and with that theory. That's why you've seen that go up. But what we're also finding is, and one of the bigger concerns I have with inflation, it was one of the earlier points that I had on a slide, was looking at the consumer's income versus the consumer's inflation that they're weighing. So what we are seeing is that inflation is increasing dramatically and starting to eat up that purchasing power. Now, especially when you look at the only people that I've seen in the last survey that I saw that really are kind of keeping up with inflation, and that was before all of the rising in energy prices and the gas price, were kind of the lower quartile because their wages went up proportionately, percentage-wise, fairly high. Now, if you look at percentage increase in wages and percentage increase in inflation, it'll look good. Problem is now with these energy costs, that's eating up most of that. The other 3/4 of the population, they were not keeping up with inflation. We were seeing that basically inflation was starting to eat up because the wage increases for the person making 75, 100,000 weren't what they were in conjunction to the people in the lower income. Bottom line to all that is across the board, I am finding that inflation is outpacing the wage increases, which will hurt the consumer and will hurt spending on goods and services. So it is something that we are concerned about. When we look at overall the concept of inventory correction, now this really is a key slide. When I look at this slide, wholesale inventories have increased by 11.4% after inflation. Business now, so what we are seeing is that gap we had in the concept. If you look at this overall, the gap we had with the consumer looking at and saying, okay, do I need to buy stuff? Is it there? Can I get at it? So what we've seen is wages were up and sales were going up in inventories, but now we're starting to see that inventories are rising and sales are coming down. So if you look at the red line, we're finding that the pricing is changing the dynamic. So that is a big worry by us. When we start to see that basically consumer prices are going to start to affect what the consumer is buying. So we are starting to see that inventory eventually here, we're worried that the inventories are going to start to stack up again, which does worry us. Now, one of the things that I wanted to put in perspective for people is I know there's a lot of concern right now with the portfolios. And the question that I'm asking on a daily, if not hourly, if not minutely basis is, what corrections do we make to the portfolios? And again, the same as you, have to control emotion. Your first reaction when something is happening, you want to react to it. You want to do something. But we have to be cautious to be logical about what we're doing. When you look at here, when we look at some of the numbers, what we're finding is that we're finding that, basically inflation is increasing dramatically. We're having that happen. We're seeing inventory start to rise a bit. Plus, then we throw in a event-driven situation. So the question is, how long or what effect is this event-driven, the war with Ukraine and Russia, going to affect what we do? Well, first of all, one thing I do want to put in perspective, when you're looking at this overall, Russia and Ukraine are about 3% of the world's GDP. So overall, when you take Russia and Ukraine together, it's not a big part of the economic environment. Now, again, we have to, it's even hard to say that because when you look at the TV on a minutely basis and see what's going on there, I mean, there's the human element of this, which is terrible and so hard to watch. And, you know, you pray every day that something's going to be corrected because these are human lives. From an economic standpoint, it really is not a huge situation if those GDPs dramatically change. Now, what is happening though, because of Russia being such a player in the energy market, it is making a difference there. I wanted to put this chart up, and this one's a little dark, and I apologize for this, but I want you to get just a little bit of a feel for this. Basically, what this is doing is this is looking at some major events that we've had. For example, you look in the lower left-hand side, the Gulf War. The question is what happened to the markets? So what do we see 3 months, 6 months, 12 months after these major events? Asian financial crisis, US invades Afghanistan, collapse of the tech bubble, which was a big one. The bottom line, for example, if you look at the collapse of the tech bubble, we're seeing, for example, there, when you're looking at that, what we found is that things came back fairly quickly. You look at the various parts of what we had, the US, the last one, we saw the slowdown due to COVID. In general, when we've had situations overall, the comebacks have been fairly quick. And again, if I look at event driven, that usually it's the least effect to our markets. I mean, it's a big downturn, but relatively quick and relatively fast on the comeback. So what we want to do is we want to put all this in perspective from that standpoint, that we understand that overall, when you're looking at these numbers, that what we see is we do see that, that the comeback is fairly quick. I mean, I even went back and I'm just looking at some numbers here. I went back and looked at Pearl Harbor, which is a pretty big event in our history. The total drawdown right after was about 4.6%. So what happened is it took several periods to come back from that, to hit bottom and come back. But on an average, it was relatively quick. We look at the 307 days to return to the previous where we were at. So even with Pearl Harbor, the market returned in 370 days. The Iraq invasion into Kuwait in August of 90. The first day market decrease was basically you're looking about 4.9%. It was about 11.6% total we saw, and it took us hitting bottom after, and we recovered within 31 days. So the good news is usually with these event driven, and really what we're looking for is some indication in Ukraine and what's going on with Russia is how quickly is this going to resolve? And again, hate to state it this way, but either it resolves with a puppet dictatorship being put in or a puppet government, or with a situation where, basically the fighting stops and things end, which doesn't look like it's probably going to happen. Where this is going to be tougher on the markets is if you see this drawn out for quite a period of time. So that is something that we do have to watch out for overall. Now, I put this chart up to talk a little bit about emotion. This is where we all have to take a step back and try to look at logical, try to look at the numbers, the cycle, and not try to let emotion drive us out of things that we're in, especially if we're in things that make sense and are good things. I just mentioned here a couple of things. Losses hurt more than gains, and that's natural for all of us. Again, timing the market makes it tough that we miss the recovery. And I put a slide in here that talks about that very briefly, and it basically says in here that what you find is that you find over a period of time that if you look at markets, what you'll find is that they, I'll go one back here, apologize for that, that if you're out of the market, if you miss, for example, the market, 6 of the 7 best days took place after the worst days. So the bottom line is if I stay fully invested over downturns, I recover my money and things are okay. If I get out and I miss the best 10 days that happen, and they usually happen fairly quickly after the downturn, it brings my return down dramatically. If I'm out for periods of time, it lowers my return because I'm sitting on the sidelines when things rebound. And again, if we all had the crystal ball and knew when that rebound is going to happen, we would go ahead and adjust accordingly. But the problem is we don't. So that's why we're cautious. We want to change allocations where it makes sense, but we don't want to overreact and get out of things that it makes sense to be in. We look at the bottom line. We do anticipate an inventory correction. We're eliminating some of the back stock that will be happening in the coming months. Consumers will be hard pressed with rising inflation. That worries us. Consumers will need to become more conservative in their spending habits, which means less buying. So when we look at this, these are some of the risks that we see to the markets. You look at some of the COVID, supply shortages, valuations. We're still on the higher end of the valuation side with a lot of our stocks. One of our goals is to find stocks that the valuations are a little bit more reasonable. The whole geopolitical thing going on with Russia, I mentioned that, and Ukraine, that is an area that we do have to pay attention to. We can't eliminate that from our thought process. Again, overall, probably not the biggest thing from an event-driven. They're always the shortest, or usually the shortest, and what happens is they usually rebound fairly quickly. And again, we can't eliminate risk, but our goal is to manage that the best we can. Some of our themes right now are basically monitor earnings. Again, find stocks that make sense. Right now, we are emphasizing more things such as defensive sectors, your utilities, your consumer staples, things of that nature. You'll see me looking at that more and more, and I'm making changes in portfolios to reflect that. So I'm going through and looking at each portfolio to try to figure out where we need to tidy up those things. Defensive sectors normally outperform. I mentioned that. International equities are supported by a falling dollar. Now that is something I was actually kind of excited about up until the geopolitical risk that we have with the Russia-Ukraine thing. We were seeing that the valuations, a lot of the foreign markets were actually quite more attractive than ours, especially with the dollar. It was making it more attractive for their markets. Backing off on that a little bit right now, not dramatically, just not overweighting in that sector at the current time. Now on the fixed income side, we are going to have rising interest rates. So the question will be, how are we going to handle that to make sure that we're not affected on a negative in our bond holdings? Again, you have bonds for some, not security wrong reason, but give you some ballast and anchor in your portfolio, but they can be affected on a negative side when interest rates rise. So we start looking at things that are going to be giving us a higher yield, maybe some below investment grade or lower grade bonds that are still, we feel comfortable with if the economy is not too bad. Floating rate are some bank correlated types of bonds that we can look at. Inflation protected bonds through the government we look at. And for the regular bonds that we own, corporate bonds and things of that nature and various ETFs, keeping those durations fairly short. What we want you to do, and I want to keep this to right around 20 minutes, which we're getting to that point. I wanted to let you know that we're here. We're here to answer any questions. We'll go through things. Feel free to give us a call and we'll talk through it. The bottom line, we're watching the business cycle. We're watching what's going on with the event driven, and we want to try to position the portfolios. Now, that doesn't mean we're going to sit and go all to cash, because that is a very risky strategy that we look at, because you're sitting on the sidelines when things come back. If we own solid things, we're going to stay in them. It makes sense to stay in them. Now, we're not going to not do anything, and that is important that we are looking at the portfolios to see what adjustments it does make sense within reason. So that's kind of the thought process that we're looking at as we go forward. So feel free to give us a call if you have any questions. I do have a few questions that were asked. Let me just pull up a couple here. Let's take a look here. Let me see. Do we need a meeting to adjust my investments, or something you are doing on an ongoing basis? I'm doing both. It is situations where I am sitting down with a lot of people and doing a lot of Zoom meetings to make sure we're talking about making sure that we understand your time frame, your risk tolerance, how you're feeling. Very important to us, because again, this is a communication process. Sometimes I think people think there's an exact answer to investing. Anybody that tells you that there is not. Now, what you do is you put the odds in your favor by making sure that you're adjusting accordingly to where the business cycle is. And with many of the portfolios, depending on how they're structured, I can go in and make changes if we have a discretionary setup, and I do that when it makes sense. and some that are not discretionary, we do have a few of those portfolios, then I want to make sure that we're discussing those. But it is something that feel free to give a call if you have any questions on that. Somebody asked the question, what does defensive mean? I mentioned things like utilities, consumer staples. There's things that fall right now. The banking sector that's not truly defensive, but with interest rates going up, that looks somewhat attractive. So what we're looking at is, and there are some individual, I've been focusing a lot more on dividend paying stocks that fall into more of that, I have to have those stocks to live, P&G and some things like that fall in those categories. What do we need that we have to live off of? And I like things that are paying dividends because while we're waiting, we can get paid. Again, you got to make sure that the valuations of each of those stocks make sense, but that's one of the things we've been looking at. Let me see other questions here. How fearful should we be at this time? I think we should all be concerned. I mean, first of all, there's the human element that concerns me. It's very hard to watch this. And really, this is probably one of the first wars to a large degree that has played out on TV like this. I mean, we've had the Vietnams for us of a certain age that we saw every night on the evening news, but we're actually living this with people. It's hard not to look at the human side of this, and it does affect you there. As far as economically, as I mentioned, if we ignored the GDP of those two countries, it's not that big of a deal. I hate to state it that bluntly. I mean, Russia is not a major player in the world economy. Now, they're a major player because you have a somewhat of a madman running the country, and they make them a major player. But as far as the economics that they've had, their economy has not done well. Their GDP has been very, very lackluster. And that's not even probably with total disclosure. I mean, you look at China and Russia and a lot of those countries, they don't even really disclose completely what's going on. So it even could be worse than what we talk about. So the people do not live in a lap of luxury in Russia. So from that standpoint, it wouldn't necessarily affect us if we just walked away from them and didn't trade with them, but it is a big deal from the standpoint of the might of what's going on. So it does affect the market, especially short term. Longer term, if this plays out in a certain way, it should be an event-driven blip, for a lack of a better term. Again, not a blip in people's lives, but a blip on the stage. Now, if it goes further, then it's a different discussion. I mean, if he were to invade Poland or some of the other countries that used to be part of the old Soviet Union bloc, then that's a bit different deal, because then it changes our lives from the standpoint of involvement. Hopefully, and we pray that that won't happen, but we have to be looking at this. Currently, what we need to do is find solid things, make sure it fits within your risk tolerance, and adjust accordingly and be prepared to watch this stuff. And again, I'm not just reading what I'm talking about. I'm reading a lot of what's going on across the board. Let me see other questions. And again, feel free to reach out. I know that Andy put a few questions up here that he hears on occasion. How do I get the e-equip and stuff like that? Give us a call with those types of questions. We'd be more than happy to answer them for you. Well, I'm at currently about a half hour here, and I promised to keep this at about 30 minutes. Summary that I have, the bottom line for you when I look at this, and again, if you read the summary that I put out, what I'm looking at right now, again, is more defensive types of investments, making sure that we're taking advantage of those. Consumer staples, utilities, dividend payers, relatively low volatility, defensive types of stocks usually do better in this part of the business cycle. So we are looking at that. Paying attention to fixed income, making sure that we're not going to be caught with too long of maturity duration on our fixed income is important. The question is, the Fed's going to be a big part of this because they're trying to balance out this inflation. So the question is what rate increases we're going to have, how are the markets going to react to them, how much of quantitative easing they're going to continue to pull back, and we're not going to put a ton of more money out in the system, because that money out in the system has part of what's driven inflation. So those are all parts of things that we're watching on a daily basis. But if you have any questions, feel free to give us a call. I thank you for your time. And we're going to cut it here at about 12 o'clock. So feel free to give us a call. Thanks a lot and have a great day.